we put all the stuff every time?
Must be.
I talked about it on Tuesday before he left.
I don't see that guy on the business. Good genetics, I think.
Yeah, I didn't know either. Yeah. Any place down there is warmer than up here.
I was there for 2 weeks this month and it was hot, so.
All right, it's 3 o'clock, so we'll call the meeting to order. Today is March 29th, 2023, and it's the regularly scheduled Hutchinson Utilities Commission meeting. The first item on our agenda is the declaration of any conflicts of interest. Is there any conflicts of interest from the commissioners?
I have none.
None.
Being none, we'll move on to the second item, approval of the consent agenda, which is the minutes and the payment of ratification of the payment of bills. Any questions from the commissioners on the consent agenda?
I'll make a motion to approve.
I'll second.
Motion by Matt, second by Don to approve the consent agenda as presented. All in favor, please signify by saying aye.
Aye.
Opposed? Consent agenda is approved. Agenda item number 3, the 2022 financial audit presentation by Justin McGraw. Hi, Justin.
Good afternoon.
Good afternoon.
No.
Well, thank you for having me here. I'm Justin McGraw. I'm CDS, the Commission's auditors, and I'm going to go over the financial statements for the year ending December 31st, 2022. And you got a few different products in front of you. The thicker bound document, that's the actual financial statements of the Commission. As I'm going through the presentation, if anything, if you're looking for more information, I think that's a great place to start. It has all the information I'm going to cover today. We kind of summarize it for our presentation, and that's the other bound document in front of you. So everything's derived from your financial records, from your financial statements. But if you have a question as I'm going through, please feel free to stop me, interrupt me, and I'll try to answer it then. So getting into our presentation here, the first part is our independent audit report. Our audit report is our opinion on your financial statements. It gives you the standards we follow throughout our audit to come to the conclusion on whether your statements are presented fairly, in our opinion. The big takeaway on top of page 2 is that we do feel your statements are presented fairly, can be relied upon for gauging performance of the Commission as well as for future decision-making purposes. So if you don't take anything else away from the presentation, remember that one. Jumping into the numbers, your statement of net positions, the overall balance sheet of the Commission. We look at it in 2022 compared to 2021, so you can see some of the changes that have happened during the year. Your current assets here, they have a slight decrease in 2022 compared to 2021, and that's largely due to your unrestricted cash balances. So the natural gas division had a $312,000 increase in cash balances provided by operations. So what that tells us as auditors is your rates are set to cover the operations of that division. The electric division saw an increase in capital activity. So cash was spent for turning that physical cash into a physical asset. So you can kind of see that your net capital assets did decrease. That's your capital assets by setting depreciation on those assets. So even though you did have some capital improvements, new equipment, new truck purchases, those types of items, you did have a lot of depreciation during the year. That's pretty typical of a utility commission. They're pretty infrastructure heavy. So you saw your net capital assets decrease a little bit there. On the bottom half, your current liabilities. These would be your routine bills, think payroll, accounts payable, those types of items. You had an increase there in 2022 compared to 2021. That's largely due to your purchase power, natural gas bills at the end of the year in December that were paid in January of 2023. Your long-term liabilities, these are your bonds, debt, your net pension liability, as well as your other post-employment benefit liability for health insurance. You had an increase there, so you continue to make your scheduled debt payments, but your net pension liability is what is driving that increase in 2022. Para's investments, what they thought was going to happen with their investments as far as performance and what actually did happen were very different in 2022. So you saw your net pension liability increase, and that's pretty common across most entities that participate in para, at least for 2022. Then at the very bottom, your net position. So your net position, this is essentially if you could sell your assets and pay off all your debts, this is kind of what's left over. You saw a slight decrease in 2022, and I'll cover that in a little bit more in depth as I go through each individual division in the next few slides. But that kind of reversed the trend we've seen over the past several years of that increase in that net position. Looking at the cash and investment balances of the commission, we have your operating cash, restricted, as well as designated cash. You can see the 5-year breakdown. It's been pretty consistent over the years. 2018 was when you had a lot of bond proceeds still on hand with the generation project. As those spent down in 2019 going forward, it's been pretty consistent over the years for your debt reserves. Then your revenues, expenses, and your changes, which is the overall income statement of the commission. So you saw increases in your operating revenues for both the electric division and the natural gas division. And I'll go into a little bit of detail on that earlier, but the key takeaway here is your operating expenses as well. So they kind of followed that increase in your operating revenues. And a few items here that we saw that increase. Depreciation was that big one I kind of touched on a little bit earlier. Occupancy, customer service, and purchase power and natural gas, those did decrease in 2022. Maybe 2021 was a little bit higher due to some higher natural gas prices. So maybe 22 is probably back to a more normal level without any price spikes. And then your non-operating revenues or expenses had a big increase in your operating non-operating revenues that were for investment losses. So you have unrealized losses on your investments. Typically, with the rising interest rates we've seen over the last year, you were locked into some municipal bonds that have lower interest rates. As the interest rates rise, those become less valuable. But as long as you hold them to maturity, you continue to receive your semi-annual payments on the interest, and then you'll get the principal value back when they do come due. So that's probably a temporary thing. If you don't sell those investments, you'll never realize that loss. Jumping into the individual divisions, starting with the electric division. So you had an operating loss in 2022. You can see that in 2021 you also had that operating loss. It's a little bit bigger. In 2020, compared to 21, 2020 was kind of an odd year. You had a big refund from, I think it was Missouri River that came in 2020. That kind of threw off the comparability between the years. You didn't have those items to that extent in 21 and 22. So you did have a decrease in the net position of the electric division there. And here's your change in net position. You see there's 2020, you had that kind of odd year where you had an increase with that large refund. 2021, you returned back to a loss. And then in 2022, largely due to those unrealized losses on your investments, you're seeing a decrease in your net position there. Looking at revenue by class for your electric sales, essentially. Pretty consistent between the years. There's some variation between the different classes, but it's been pretty consistent as far as overall for the electric division. So nothing here that strikes us as being out of the ordinary, depending on the usage and what class is using what amount of electricity. So I think we got here the Energy Information Administration thinks for Minnesota you should be right around that 11 cents per kilowatt hour rate. Then again, it does depend on what type of class is using more energy versus less energy. The natural gas division. Natural gas division here also had a loss from its non-operating revenues in 2022. Again, that's largely driven by those investments. You can see when you look at just operating revenue versus operating expenses, it did have, I guess, a positive impact on your net position, slightly offset by those non-operating expenses. So, and that's pretty typical. You can see if you go back to 2018 to 2022, the natural gas division, from an operational standpoint, has fared pretty well with the revenues it's bringing in versus the cost it takes to provide that service to your customers. And you can see you're changing that position. So it has been decreasing a little bit here. It's kind of stepping down from 2018 to 2022. 2021 and 22 are pretty comparable. So that's pretty good, especially with the unrealized loss on those investments, that you didn't see that impacted as much as you probably saw in the electric division. So good for the natural gas division to kind of combat some of those non-operating losses that you saw in the electric division. And then looking at the revenue per metric cubic foot, again, pretty consistent. They're slightly down in 2022 compared to 2021. But you look at the change in the classes between the years, overall, residential is down slightly, commercial down slightly. You saw some of that made up in that large industrial category. Unfortunately, large industrial is a little bit lower revenue per metric cubic foot than commercial industrial. So as they shift between classes, the usage shifts, between classes, it has an impact on that overall revenue per metric cubic foot for the division. And then, in addition to the numbers, that's all I'm going to talk about, the numbers. So I'm going to talk about a few other things. We look at how the commission operates, and throughout our audit, if we have any recommendations or informational things to pass on, we put it in our management letter. So that's the thinner bound document that you have in front of you, and it lets you know how the audit went, any disagreements or any misstatements we came across that were uncorrected. We're happy to report we had none, so that's great. We do appreciate all the effort of your team here. I know we ask a lot, not only of your team, but your banks, your vendors, the state. Everybody was very helpful in getting us to the point we're at right now, where I can come here and do the delivery. We also talked a little bit about new accounting standards. So there wasn't one new accounting standard that was implemented in 2022, and that's the new lease standard. And with that, looking at the leases that the commission is involved in, the big one that we booked was a land lease for the solar array. So that's a lease you're in with the city of Hutchinson. So you probably saw, if you're looking at your statements, a new item on there, a right to use asset for that land and a lease liability for those future payments. So that's a new standard we implemented in 2022. And then recommendations, this is really a recommendation, more of an informational item. Similar to the lease standard in 2022, there's a new accounting standard coming out for 2023 here that relates to subscription-based IT arrangements. So kind of think of it like a lease standard, but for software, cloud space, server space. What you're going to see there is it's kind of the same principles as the lease standard, but you will have, instead of like a right to use lease land asset, you'd have a right to use subscription or software asset. So it's basically some new balance sheet items you may see on your statements in 2023 related to IT type items. So with that, we talked to your team here, let them know about this new standard. They were aware that it was coming down the line, and we asked that as they prepare for 2023's audit, keep this in mind. If as you're paying those, if it's a subscription bill or something, put it on a list of, hey, this is something that may apply for this new accounting standard that when we come out for next year's audit, we kind of have a head start on identifying those types of agreements.
So in those situations, do you book an asset and then a liability?
Yep. So because you guys don't really generate software, so you probably won't be on the lessor side of it, you'll be more on the lessee side of it. And you have a right to use asset similar to the land, but it'll be an IT asset, and then a liability for those future payments that are going to be made over the life of that agreement. So we'll pick an interest rate, we'll present value it back to a point in time, your balance sheet date, 12/31/2023, and then you'll have that sitting on your balance sheet for the life of that agreement.
So then will we see the liability and the asset decrease
Yeah, they'll be
in tandem?
Yeah, they'll match.
Yeah.
So they'll match, and every year you'll just drop a part of it. So, yeah, it's a new standard that's coming out to get somebody off balance sheet financing that used to be there for years onto the books on your balance sheet so everybody can see it.
Do we, Justin or Jared, do we anticipate much for entries coming on this lease change in 2023's financials?
We talked, and You thought most of it would be booked through the city since we pay the city for
Right.
IT.
Yeah, unless there's something that you that's specific to the commission, that the city maybe would be booking on their end in their general fund or something. I was thinking, accounting software, but that largely runs through the city. That's gonna be a big one for a lot of our clients.
And our accounting software is just year to year as
Yeah.
well. We just pay for 1 year.
So I don't know, some of the more operational software that's used back there may be different. I'm not as familiar with those agreements. So that could be one area where I thought, okay, maybe there's some special software that you guys use to keep the lights on and the gas flowing that maybe has like a 5-year, 3-year agreement that we'd have to look at.
And by its nature, IT leases or agreements should be shorter than, say, land leases and
Correct.
solar arrays, so it should be less of an impact, probably 3 to 5.
That's kind of the thing. Most of them, we're seeing 1, 2, 3 to 5 years is probably a common time frame. Because IT changes so quickly
Yep.
that it's probably obsolete by the time it's 5 years from now. So it may have big impact, it may have no impact. We'll I've tasked Jared with finding out for us. So with that, I'll open up to any other questions anybody might have right now.
I don't have any.
Well, we can do it.
All right. Well, thank you very much. Again, if you're looking through this in the free time and you have questions for me, my contact information is on that last slide. So feel free to call, email if you're driving through Litchfield, stop by. All right. Thank you.
Thank you.
Justin.
We'll need to approve that audit, so I'd entertain a motion from the commission and a second to approve the 2020 financial audit as presented.
Thanks, Justin.
I'll make a motion to approve the 2022 financial audit as presented.
I'll second it.
Motion from Kathy, seconded by Bob, to approve the financial audit. All in favor, signify by saying aye.
Aye.
Opposed? Motion is approved to approve the financial audit. Thanks, Jared, to you and all your staff. Jeremy, for your work on that. Good to see the audits come through with no issues. So thank you for that. Next agenda item is to approve the financial statements.
Let's
Jeremy
start
or
on
Jared?
the electric side. You can see the net loss is very similar to the year before, despite lower customer revenue. But that's also offset by lower purchase power and gas to generate. So, gas side saw pretty much also the same bottom line, despite lower usage as well. It was a little warmer than last year. We're also seeing little economic factors factoring in and slowing down. But you'll also see then with the electric side, the fuel purchase gas is down as well to match that lower customer revenue. You'll also see the operating expenses were down this year compared to last year. Last year they were a little high because we had the start of the pigging project, so there was a few extra expenses that month last year. Other than that, that's about all I have.
Yeah, just touching a couple kind of more high-level things. Jared had mentioned just that the generator fuel is down. We've touched on that the last couple of months, that we didn't contract natural gas for the winter this year like we did last year for running generation, so that actually saved us costs. Because at the time we were looking at locking in natural gas prices that were extremely high. So we ended up saving significant money there. What you're seeing, obviously, in the natural gas industry right now, the western part of the state through the winter, or the western part of the United States through the winter, has seen cooler than normal temperatures, but the Midwest and the East, which is 2/3 of the country, has seen warmer than projected, or warmer than normal winters. So you're starting to see increase in storage for natural gas. You've seen prices come down with continual production and rigging moving forward. So we're seeing, spot market gas getting a little bit softer here in the short term. The generation side, or the market energy side of things, is lagging a little bit behind that. So you'll notice in these February financials that our cost per megawatt was still higher this year than it was last year. So the generation, or the MISO prices, haven't quite followed as quickly as the natural gas pricing on the natural gas side. Usually those have a correlation relationship between cheaper natural gas prices typically bring down the MISO prices because a lot of generation that's dispatched in the MISO market is based on natural gas. So there is a little bit of lag there. That still hasn't quite happened. So we're still seeing, a little bit higher, at least through February, MISO prices than what I would anticipate. But they are expected to come down a little bit based on consistent loads in the market. So just want to give you kind of a high-level kind of idea on what's going on in the natural gas market relative to the generation side of things. And then just a couple of pieces to touch on, highlight. If you guys look back at those cash designation reports, if you guys are watching and following some of those ratios, you can see that we've had a big variation in our return on net assets benchmark numbers. And so I had Jared just put in some notes basically highlighting to the commission why we've had some significant ups and downs with return on net assets. Again, Justin touched on in 2020, not only did we have the MRES reimbursement of $1.2 million, but we also had the insurance proceeds for the plant damage up there, and that was about $400 and I think $60,000. So that $1.6 million is typically not expected. So you'll see a positive return on net assets for 2020. That isn't going to be common numbers. And then 2021, that's probably going to be more of a consistent in that, zero range, negative, 0.5 ish range as we move forward. And then obviously 2022 at a negative 4.2, that takes into consideration the mark-to-market adjustment that we've talked about, which was 1.4 million net loss, unrealized on the books. And then the pension obligation on that was, that net change was, about $600,000-700,000. So those two things really skewed that return on net asset value. I'd like to go back to this to make sure you guys, if you have a couple seconds, just to touch on those graphs, to make sure you guys are clear. He didn't quite highlight some of the numbers that I think will be important. And then the last thing on the investment, I just wanted to highlight that obviously with projects coming up, we've got the Unit 1 repairs. We're going to be talking about the Hutchinson substation improvements coming down the pike. As investments mature, we're moving on more shorter terms. So you'll start noticing on kind of the bar chart that they're moving towards the 4 years or less. Right now, obviously, you guys know with the interest rate environments, we're getting good yields on the short term. So as those longer term things come in, we're keeping them a little bit shorter. Make sure we have plenty of liquidity there. So that if the commission wants to decide on using cash to fund certain things, we've got that stuff available, not only within our checking accounts, but also investments if we need to, when they mature, bring those into paper projects. So just wanted to highlight that piece too, that there's a conscious effort to move those things to a shorter term. And we still need to go through our cash flow analysis over the next 5 years, so we got to go through that exercise yet and kind of piece all this capital back together. And I've done some of that in the 5-year budget forecast, but I need to really refine that. So when we get together and talk about planning session items, you guys have a good idea kind of where we think our cash balances will be, and we can talk about decisions that the board will have to make on how they want to use cash versus financing and different options on things. So I just wanted to highlight. I only highlighted the electric division. When you go to kind of the bottom line, basically the change in net position. We're at a negative $2.5 million this year relative to $500,000 last year. If you look at that number, so I just wanted to highlight the specific changes that accounted for that. So again, the electric pension change in pension obligation, that's a net negative impact of $478,000 relative to last year. So you've got that $500,000 roughly increase in negative pension. You've got the mark-to-market adjustment of $700,000. So you're roughly about 1.2. So if you pull those entries off, your operational piece is about a negative 1.2, which is higher than the 534. A couple other things just to remind the commission, as we've kind of talked about through 2022, our operating expenses were up. We had significant repairs on the Unit 1, significant repairs at some of our other infrastructure and facilities, and so we had about $600,000 more in our operating expense area than we typically saw in 2021. For a whole host of reasons. Some of our operating expenses were up because of, increases in purchases for infrastructure, transformers, equipment, things of that nature. So that's a big change from one year to the next with just inflationary costs. And then the other piece is we had just more labor costs showing up on the income statement in 2022 than 2021 because we didn't capitalize as much labor in projects. Obviously, coming off the COVID years, we're still doing a lot more maintenance and upkeep than we are actual development in capital project stuff. So when you look at year end, I think we were up about $700,000 in labor. A big portion of that is because we just didn't capitalize it and put it on the balance sheet. So those are kind of the big area items that kind of show that. But about a half of that is those what I would call book entries that really aren't operational.
Do you see
things.
2023's work mix, or is it might be too hard to forecast? 2023's work mix having something similar to 2022, where it's direct expense versus capitalized, or how do you see 23 playing out in comparison to 22?
We'll have
We
more.
didn't really see labor go up 700,000. It's just how we accounted for it.
Correct. We didn't capitalize it, right? So I do see us capitalizing more labor this year than we saw last year. Getting through a year of doing some maintenance and some upkeep on things, obviously helps that. We are going to have developments, and at least on some of those areas we're looking to change out some infrastructure and continually get back on that schedule and redirect some of that. So I do see that will change some. How much will be based on timing of new development versus our own projects, what businesses are coming into town, and then how much staffing time we have available to do things, weather permitting. If we get a bad spring or a bad summer where it's just hard to get out and do construction projects, that will have an impact on labor on projects and capitalization. So, but I do think it'll be better. It'll be back to hopefully a little bit more normal than what it was this last year. We've had a year to kind of make some catch up on some of our just annual maintenance stuff, at least on the electric side. On the gas side, we've got some additional maintenance things that still need to, get back to some normalcy with, getting fully staffed on those sides and kind of getting caught up on those areas. But I don't think it'll be like it was this last year. I'm on that side. And then on the operating expense sides, particularly on the electric side, I don't see us spending that kind of those things on the things that we did last year. We tried to troubleshoot things, and then that didn't work, and then we tried to troubleshoot something else, and then that didn't work, and so that was kind of the preempted step to take this thing out of service eventually and get this thing fixed, because we're just spending too much money trying to figure out what's going on, and we just need to get it out and take it to the experts to have them to do those things. So there were a couple anomalies, kind of the big ticket items that really skew the 2-year difference there on the electric side. And then on the natural gas side, very comparable to 2021 as far as change in net position. 2021 was 1.2 million. This year was just under 2 million as well. The gas pension was $160,000 net negative impact, and then the mark-to-market was $701,000. So you've got $860,000 in net negative impact. If those book entries weren't normal book entries, we would have had more of a year like 2020. And that's really what we're anticipating. When I look at the margins that we have on our gas supply and our fixed pricing and our rates, we should be in that $1.6 to $2 million net profit range on that. So we're not going to have a book entry mark to market any bigger than what this year was, which is how fast interest rates rose and some of those things. So I just wanted to highlight those big things in case there was some concern or some questions about why from one year to the next did we really see those big things. And we've talked about the pension a little bit. Those are really state obligations unless they change state laws that says, hey, public entities, you're required to make up the difference that isn't going to be provided by the state and their investment portfolio. We're a pay-as-you-go. We make our contribution plans through payroll to the organization down there that pays out the pension. So, but we do have to show it as a potential long-term liability for employees on the books. No different than our OPED liabilities where you've got that too. So, and no different than the land lease, and no different than some of these things. You show those things, but we're more of a pay-as-you-go, and we don't have these in concept of large liabilities that we're going to be on the hook for again unless they change laws on that. So, Any questions on kind of those big changes? You know, we touched on it, but I just want to make sure I highlighted it again for you guys so you
The,
kind of knew that.
the audit standards, and the CDS presents it how they have to present it per their professional standards. So that is what it is, but when you peel back those numbers, Jeremy, that you talked about, 800 and some thousand in the gas division, that earnings were impacted by. And that's just accounting entries, right? And if you flow that through from a management perspective, my only question would be, is RONA still, on our monthly financials and our cash designation reports, is RONA still the right ratio to measure by because it's influenced by those non-operating accounting adjustments?
No, but it's a standard that is used in the utility world. You know, and obviously if you're a private or investor-owned utility, you don't have the net pension obligation because you're not a public entity, right? So you don't have those book entries. So it's hard to compare an investor-owned to a public-owned utility. So if you would take those pieces out of it and you just looked at those extraneous things out and then re-looked at your return on net assets, I think there is some general value, you know, from a RONA standpoint, meaning are you maximizing, when you're putting in assets, are you getting return on those things? So there is some value into it. But to your point, Anthony, you got to be able to exclude some of those things, and the numbers that you're seeing aren't excluding those. They just take your operating income or loss, and I could certainly pull those out.
I think that would be
Look at
beneficial to
that.
see it with those pulled out, in addition to what we see here, to see kind of a standardized look at it.
So two RONA calculations, one is stated, one with operation.
Yeah, just your operating.
Standard operating.
Because if you
stuff above
excluded
the line.
those, that'd give you your standard year-over-year performance.
And I bet it would be more steady.
Correct. Yeah, I would say you would be more like what you're seeing year-to-date 2023. You know, if you pull those anomalies out, that's why I want to make sure we're highlighting that in case you're looking and you're going, oh, why is this thing bouncing up and down? We're going to be in that, like I said, 0 to negative 0.6. I mean, we've talked about on the electric division side, we've got so many assets out there. We've got such depreciation, and you know we've maximized a lot of our capacity, excess capacity now with all the contracts we're in. But we've just got a lot of infrastructure out there, and so you know, if you can get around that break even, you're doing pretty well. We're certainly typically, from a public utility standpoint, we're never going to raise rates and overcharge people consistently to build that RONA up to an investor-owned utility. That's just not the business structure that we're running, nor is it ever a comfort level of a public utility. But I look at it for some general framework, but I don't hold my hat on it when I look at that. I think we are trying to maximize things here, and you just don't want it to be an anchor, right? You don't want your assets to show significant large reductions in negative percentages and not maximize your assets. So
I'd say just think about that, whether you want to continue with RONA as stated or add another RONA or replace this RONA calculation with RONA based on operations. Because right now it's understating your guys' performance, and later on when the rate cycle changes, it'll overstate it.
correct.
And it's a zero-sum game in the end, but it's harder to measure. As
And the pension liability you have no control over. I would say on the investment side of it, there is some management control there. You know, because the duration on some of those investments, I think the loss is greater than.
I actually looked at those.
Investment chose to be shorter, but we don't plan on selling them. But it does limit your ability to move on from them if we wanted to use it to spend cash.
I'd follow your lead, Jeremy. If you have a recommendation of replacing or adding another calculation, feel free to do it.
Yeah. Okay.
I think the concept of RONA is good to have on there. Just if you think it's better presented somewhere else or some other way, feel free to do that.
Yeah, I could certainly take out the big anomalies. I mean, I could take out the insurance proceeds and just look at normal operations, and maybe that's, to your guys' point, that's a better indicator than. We've just had, over the last several years, we've had some of these big kind of anomalies that we just typically don't have. You know, we don't plan on getting a reimbursement from our wholesaler for, that kind of money in. So they're nice when they come in, but it's not, you're not banking on those for your course of operation and setting rates. So, but certainly let me know if you guys have questions on any of that stuff as you look through.
Any other questions for Jeremy on the financials? Or Jared? If none, I'd entertain a motion to approve.
I'll make a motion to approve the financials.
Second.
Motion by Don, second by Kathy to approve the financial statements as presented. All in favor signify by saying aye.
Aye.
Opposed? Financial statements are approved. Agenda item 5 is open forum, where public is allowed to speak to the commission. Being no public here, we'll move on to agenda item 6. Communication, start with City Administrator Matt.
Thank you, guys, gals, sorry. Don't have a whole lot for you. Our annual spring cleanup is April 22nd. Everyone always kind of looks forward to that city holiday, it seems like. And then we're basically wrapping up our police station. So we're supposed to hopefully have the keys by the end of this month, probably start moving in May. So kind of, or not say this month, end of April, probably moving in May. So just kind of punch list items that we worked out with that. So.
At City Hall recently, say the last couple months as compared to last year, same time, is there less activity in building and development, or same, or?
Less in residential. We're seeing the same when it comes to commercial, which was a little surprising. But, you know, we had 24 homes built last year in 2022 compared to 36 in 2021. And the 24 that were built last year were probably built in the first half of the year. So, and one of the challenges that we have is that there's about 90 buildable lots in town. Those are all owned by builders. And so that's about a 3 to 5 year window, depending on how many you're building. And so one of the things we're looking at right now is a growth planning study on future development of lots. But I think right now there's about 5 commercial projects that are going on, which has been pretty consistent with what we've been in the last couple of years, but housing definitely has slowed down. So.
Thank you, Matt. Divisions. Dan, we'll start with you.
Nothing today.
Jeremy and I met with the rate study last week. We have another meeting tomorrow. Probably we'll wrap it up tomorrow, really, I would think. And then it's just a plan to get the information in front of you guys how we want to do that. Should be hearing shortly. That's all I have.
Thank you, Jared. John?
I just have one thing. I'm meeting with Heartland Corn Products tomorrow afternoon, basically to find out if we have a project this year or not. I don't know if it's gonna go or not.
Like at all, or just this year?
This year.
Okay.
This year.
It's go time, huh?
We're moving forward on, right now we're out getting prices on most of our station equipment that's required for us. Just if we don't move forward, at least we know. I mean, if we have a commitment from Heartland Corn that it's going to go next year for sure, I'll go ahead and have the skids built this year. It'll be cheaper this year than it will be next year, and we can keep them back here in cold storage. They'll be fine. But yeah, I'm not convinced it's going to go this year. It's moving pretty slow. So we'll see.
That's good. Thank you, John. Angie, anything in your world or human resources?
Yeah, actually, we're interviewing for the account supervisor position, Terry's old position. We had interviews yesterday, and we're hoping to make a determination by the end of the week on that. And then currently in the natural gas division, we are posting, it's been posted now for a week, 2 positions, a gas meter position and a welder service person position. And both of those are posted internally, externally, and those come down April 6th. So right now we have about 18 on the gas meter side and a couple on the welder side. But yeah, so hopefully that'll go well.
Very good.
That's all.
Thank you, Angie. Legal, Mark Sabora is not here today, so we'll move on to General Manager.
So I did send you guys a couple lengthy emails. Hopefully you had a chance to read it. If you haven't, please take a chance to take a look at some of that stuff. So I won't go into a lot of that stuff. Obviously a lot of legislative stuff's going on, sessions, just trying to keep up on all the stuff that's being thrown out there. I think most of the stuff is going to be pushed into a big omnibus bill. and then sent to the finance committees. Anything that has any funding or appropriations that need to be attached to it has to run to the finance committees. So the next deadline is April 4th. So that just seems where a lot of the stuff is going. They're not even going through some of their own committees. They're just pushing them onto a big bill, and they're going to run it through the finance committee, and hopefully they get approved there and then moved up for passage. So we're watching some of those. Obviously, the big one is the 2040 carbon-free. That one's already in place. There's some other smaller ones that would, if they go into place, would create some reporting, things for us as far as what type of renewables we have. There would be some potential for disseminating electric data of consumers, and a lot of these things really, kind of surround, are we moving towards a cleaner Minnesota, and how do we make sure we are putting programs in place and providing funding to help accommodate those types of things. And so it's kind of the theme of a lot of those things. They're looking at rebate programs and trying to move people's buying preferences to more electric things versus gas, and so there's a lot of those things going on right now out there. So I'll keep you guys updated on things that may have some substantial impact other than the 2040. Some of these are kind of more minor. A lot of these bills are being targeted by to the investor-owned utilities, and then that's usually how most of these things start, and then they try to glob on the co-ops and the munis into those things, and if you can push back on some of that, that's great. If you can't, it gets kind of lumped in there. So that's how a lot of that stuff starts, but working through a lot of that stuff. And then did send you an update on some of the different areas going on. Dan and I did meet with MRES on some joint potential partnership behind the meter generation. So we've got a little bit more work to do on some of those areas to see if there's some potential opportunities there. They are going to be short capacity moving forward, and so we got to work through a couple details and some deliverability things to see if that's possible. Obviously, one of the big things out there is you want to add in more generation if you're going to have to be more carbon neutral in the state of Minnesota. So those will be some conversation points that we'll want to talk about in a planning session, and really dive into a little bit more of the details on how all these things may or may not work, and see where the board really wants to be on some of those things. So we are looking to get a joint planning meeting together with the city council. Looks like April 17th is the best date, so that's a Monday, sometime in the afternoon. So take a look at your calendars. I did kind of respond back to Matt today, I think of 3 o'clock or something later in the afternoon. I know some of the council members always work a little bit later, but if something works for you guys in the afternoon or a certain time, that would be good to know, and then Matt can
I
really...
think we're pretty flexible, probably anytime after 1.
Okay.
Thinking a couple hours, right?
Hour and a half, 2 hours.
Hour and a half, 2, yeah. Any preference on time for you guys?
Probably the earlier the better, but
So we're
generally
staying away
available.
from later in the evening stuff?
Yeah,
Go 1 to 3 or something like that.
done by 4 should be fine.
Should we shoot 2 to 4?
Let's do 2 for
If we're done early, we're done earlier.
Done, man.
That
Kathy?
sounds good.
Okay. Angie, can you
Perfect.
send that out?
I will.
Thank you.
And then I mentioned if you guys have any topics of interest that you want to have added to the agenda, let me know, and I'll pass those on to Matt. Matt and I will coordinate back and forth between the council and the commission on agenda items, and we'll try to come up with a plan, or at least a general structure for that. So, and then we should also be, and we've got your guys' calendar too, we should also look at a planning session in April as well, for us to kind of talk about a lot of these things going on, the cost of service study results, where we're at financially, the Hutch substation project.
You were thinking prior to the joint meeting?
I was, but I don't think that's gonna happen on
It
now.
won't work with their schedule.
Correct. So we're probably looking later at either week of the 24th or
Mhm.
last weekend probably. Because I think some of you guys have a conflict on some of those other ones. So we'll try to work around that piece. And I got a few things I gotta get yet together, so it'll take me a little bit of time to put together an agenda for that. So just kind of keep that on your radar screen, and we'll kind of follow up with you guys on the planning session and talk about a lot of that stuff too. So there's a lot of things going on, and get some feedback from the board and some direction on some things. So. Thank you. That's all I got.
Moving on to agenda item number 7, policy. 7A is to review policies. There's no changes proposed to section 3 of the exempt handbook and section 3 of the non-exempt handbook. Any questions from the commission on that?
No.
Moving on to agenda item 7B, approve changes to the policy relating to employment of relatives.
Yes, so that is the one policy that's up for changes. We're looking at cleaning up some of the language on the second and third paragraph sentence on these. The first one being immediate family members may be employed by HUC provided there is no direct report relationship. We're looking to make it to clearly identify between department heads and direct reports. So we want to change that sentence to no member of a department head's immediate family shall be a direct report to the department head. We just want to make it clear that department heads should not have any immediate family reporting to them, since department heads make disciplinary actions or whatnot. So we're looking to make that change. And then that third paragraph sentence, we would like to change that to no member of the general manager's immediate family shall be a direct report to the general manager. Both of these kind of mimic what the city has in their policy, and it's just a cleaner language, so we would just kind of like to have that language up here as well.
So I see you deleted the commission piece of that?
We did, yes, since there would be no employee that would report directly to the commission, so you guys wouldn't be making that corrective action. It would be the department heads that makes corrective action. So if you're okay with that. But then I would also like to add, just to talk about that last paragraph a little bit, that last sentence. A former commission member may not be hired as an employee of HUC for 2 years after the end of the commissioner's term in office. Jeremy and I just had a couple, questions. That's why is it 2 years? And then talking to Mr. Sabora, 2 years actually comes from the bylaws. So just a good understanding for all of us that might not have been part of that conversation. So we just wanted to make note of that and kind of share that with you guys.
So just to clarify, I did talk with Mark Sabora about these proposed changes. Since he's not here today, I wanted his opinion or to come in, and he's okay with the proposed changes. Really, the second paragraph that's struck is really no change in principle. It's just clarifying language.
Correct. Yes, that second paragraph there. Yeah.
And then the third paragraph is actually a change that's being made with the intention of that. So just to clarify that, Sabora is okay with it. I read through it and got comfortable with it, but I think
So basically they were going from a ban of family members to the direct report piece.
it's now a function of direct report. And then clarifying that the current member of the commission may be employed at Hutch Utilities. And I talked with Jeremy about this as well. There's nothing pending that's bringing this to the commission's attention. There's nothing behind the scenes. This is just a general policy review and update. Did I say that correctly, Jeremy?
Yeah, and I think the other piece that we talked a little about was the direct report relationship. We wanted to make sure it was clear, because we do have crew chief positions here that are leads, but they don't have the authority to make corrective actions, to discipline people. They're there for coordination, direction. So we want to make sure that it was clearly understood by the commission, by employees in the organization, that the direct report, the conflict of interest there is really with a department head or the general manager who has the authority to do things, not necessarily having it so generic that there could be some interpretation by, well, I directly report to a crew chief. He gives me my schedule for the week and blah, blah, blah. That's not the intention of conflict of interest. It's who has the authority to make decisions that impact an employee.
Reviews, discipline.
Correct, discipline, right. So it was just cleaner language. It's just language that you see more relevant in policies and our language. So.
Additional clarity is never bad.
Yeah. Any questions or feedback from the commission on the proposed policy changes?
Not here.
Seeing none, I'd entertain a motion to approve the proposed changes.
I'll make a motion to approve the changes to the employment of relatives policy.
I'll second it.
Motion by Don and second by Bob to approve the proposed changes to the policy employment of relatives. All in favor, please signify by saying aye.
Aye.
Opposed? Changes are approved. Thank you, Angie. And at this point, I don't believe we have any unfinished business, so we'll move on to new business. 9A is approve entitlement extension of Northern Natural Gas Transportation Contract number 102733. I believe that's John.
It is, thank you. Contract number 102733 was reduced from I don't even remember the total now, but it was a generation contract for Unit 1, is what it was originally purchased for. And in 2003 or 2004, that would have been reduced down to the minimum level of 50 decatherms a day. And we maintain the 50 just so that we can keep Station 2 open, so that if we do have a failure on our pipeline, we can still flow gas on Northern Natural. Of course, 50 decatherms a day is nothing, but then we would have to go out and work with marketers or other utilities and get capacity from them and still flow. So 50 is as low as you can go. That's their minimum that they allow. As you can see, last year, the impact to us was roughly $7,500, so it's very minimal. But Northern is in the middle of a rate case right now. You can see our December bill or our December invoice was $973. Our January invoice was $1,850. So the rates have doubled. And that's what they're shooting for, but they're not going to get it. So we'll just see where everything ends up. We're not involved in any of the negotiations. Money's not spent for that. But I'd like to extend this contract just to allow us to have some backup.
Any questions for John on the proposed extension? None, I'd entertain a motion.
I'll make a motion to approve the extension of the Northern Gas natural gas contract number 102733.
I'll second.
Motion by Bob and seconded by Matt to approve the extension as presented. All in favor signify by saying aye.
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 Opposed? The extension is approved. Thank you, John.
Thank you.
I believe you're up again. Agenda item 9B, approve 3M's natural gas transportation and daily swing supply agreement.
Thank you, and I promise I'll keep this much shorter.
No worries.
As all of you are aware, we have a transportation contract with 3M. They transport on our pipeline and our distribution system. They're not part of our normal industrial rate. They have their own rate. So it's a year-to-year contract, and it expired March 1. It's their obligation to reach out to me to renew, and of course they didn't. So it's late. I'll let you yell at me if you want. But the new contract will be from March 1, 2023 to March 1, 2024. Same rates. Nothing has changed at all in the agreement except for the dates.
Commissioners, have any questions for John on this one?
No.
I would make a motion to approve 3M's natural gas transportation and daily swing supply agreement
I'll
as
second.
presented.
Motion by Matt, seconded by Kathy to approve the 3M agreement as proposed. All in favor signify by saying aye.
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 Opposed? New contract with 3M approved.
Thank you.
You bet. And the last agenda item is 9C. Approved requisition number 9482 for a 2023 Silverado. Jarrett.
This is for purchase of a new truck that was damaged, basically totaled about 6 weeks ago, our inventory truck. Just didn't have a stop sign and two other pickups collided and sent one of them into ours. So As you can see, the insurance proceeds were about 22,000. We bought the truck for 30 about 9 years ago, so not too bad. But now we can't get trucks on state bid anymore. They're just not available. So we went to a few dealers and got quotes. Schweter's of Cold Spring was the lowest. I have 44 at 118.85. They came back today and the plate fee was $30 more, so it'll be 44 at 148.85. But that's our recommendation. It was scheduled to be replaced next year anyway.
So nobody injured in the accident?
Nope.
No, it was fine.
Then it was slightly fortuitous.
Yeah.
And that's something we kind of touched on, just a little background. We got together and talked about fleet. Again, just some general things with what we're seeing with supply chain and you know, the state bids and quantities not coming in. You know, we may need to look at changing, going back to some of the old ways that we did it, where we're going out and getting quotes from dealerships and seeing what the best price is out there. No one on the state, any of the contractors or any of the dealerships in the state bid, they can't guarantee they're going to get trucks anymore.
They don't have inventory.
We don't have inventory, and even some of these ones that we're talking with, we're not going to hold it. So, you know, if you need to get it approved, you know, we're playing that game. Well, we can't get it approved till next week, and we're probably good for it. You know, we're not, you know, we're an organization, but so we're starting to play that game. But we're hearing that all over the place. We've talked about the digger derrick truck, our big truck that needs to get replaced. We've talked about that, and that's a 5-year. They're talking, you know, 48 to 60 months out. They just can't get chassis in there, so that kind of prompted some of our getting back together, talking about fleet. Obviously, costs are going up exponentially. You know, some of these 1500s, you know, we were paying 28, 30,000. You know, 4 or 5 years ago. Now they're 40, 45. And a lot of the manufacturers aren't doing a lot of the baseline work trucks. You know, some people just aren't getting them. They're adding different things and getting people to sell them that way. So we're having to rethink of how we're buying things and, you know, looking at our schedules and looking at our costs. And so that way, part of our planning session as well, I'll bring that together because our funding level is increasing.
So we might need to change how we give you the ability to go buy maybe a preemptive approval to an X dollar amount so you can go out and make the purchase.
Right. Well, we always can do the lowest bid. The state contract has always been the lowest bid. So our policy we have in place is you have to go out and at least get 2 quotes on anything. We've just never had to get quotes on the vehicles because they've been plenty enough quantity on the state bid. Well, so we looked at the state bid. They don't have any. We did the Sourcewell, which is a venture purchasing power thing that you can buy vehicles all over the country, that they're running into problems with getting inventory. So what we're finding is in order to get inventory and stay on some general schedule where we're not getting everything smushed together in a year, we're having to just go out and find things on lots and trying to do that. So that may increase some of the costs a little bit. So we've talked a little bit about that. I mean, are there some areas where we just can extend some of our vehicles? Of course, when we talk to dealerships and we talk to people, at the state, and we talk to different vendors and manufacturers, you know, they can't tell us in 3 years from now if the supply chain and inventory is going to be better or not. So you're kind of playing that game of what do you wait and see if you can get something down the road. We talked about the big digger derrick truck. So if we wait 4 years, can we get one in a year and a half? Well, you know, we can't tell you that. And so if you don't, and these big specialized pieces of equipment, if you don't put your purchase order now and get it in the queue, it could be, you know, it's first come first service how they're looking at them. So a lot of them have the bodies built, they're just waiting for the chassis. So we didn't come forward with the digger derrick truck this month. So we need to have some additional conversations about what our best options are, because that one also went up in price from several months ago. It was we had in our program about $310,000 in that for the big digger derrick truck. Now it's $380 plus tax, so we're looking at over $400,000 for a digger derrick truck. So the one we have is a 1999. So you know, we've talked about how long can we extend that piece. You know, it does get used fairly frequently.
Hopefully 5 years.
So if I knew we could get one, if we waited 4 or 5 years and we could get one within a relatively short amount of time, that would be one thing. But if we're going to wait 5 years and then that's another 4 or 5 years to get one and you're 10 years out, you know, on a by that time you're in a,
So they're not guaranteeing what it's gonna cost
they're
in
not,
4 or 5 years.
no, and that's the other piece that's a concern, which is why we need to stop, because I said, well, I'm gonna have a little concern trying to get the board to say, hey, approve this vehicle. We don't know what the price is gonna be. You gotta be comfortable with it. So really, the two mechanisms are either we create such a significant range and have you approve that, or we would have to come back probably with a change order. So we'd approve what we think the cost is today, but then 4 or 5 years from now, which is gonna have different board members on here, come back and say, hey, we need a change order for another 60,000, because, oh, remember the thing you approved 5 years ago, now it's, so it's just a dilemma, and we're not the ones facing it, but it makes it hard to
Yeah.
come forward to a board to have you guys approve things when there's just no timeline on some of this stuff, so. So we're having some conversations, but we'll try to bring some of that back too, and we'll talk about the fleet. Dave went back through and kind of repriced a lot of our fleet stuff, and we were typically around that funding level of 170 to 200,000. Now it's at 240, 250 net funding with proceeds coming in from sale of assets. So that'll be part of our conversation too, in the big picture of looking at all our operations and our cash and all those things, is to relook at the fleet and where it's at right now. So probably more than you want to know, but I think it's just some context for you.
It's a problem, that's for sure.
It is a
Yeah.
problem. So,
Very hard to plan.
I know.
All right, so there's been a $30 increase in the amount
Yeah.
for to accommodate the plate fee that Jared talked about. So do I have a motion to approve requisition 9482 with the new amount of $44,148.85?
I'll make a motion to approve requisition 9482 for the 2023 Chevrolet Silverado 1500.
Do I have a second?
Yeah, I'll second that.
Motion by Kathy and seconded by Matt to approve the requisition 9482 with the new revised amount. All in favor signify by saying aye.
Aye.
Opposed? Requisition approved. Thank you, Jared. Anybody have any additional new business? If there's none, I'd entertain a motion to adjourn.
I'll make a motion to adjourn.
Second.
Motion by Don, seconded by Matt to adjourn. All in favor signify by saying aye.
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 Meeting is adjourned. Thank you.